If you are a sales rep making over 15K a month and you are only meeting with your CPA 2 or 3 times a year and not running projections and plans for how your tax season is going to go, you have a historian, not a strategist. And this is costing you 6 figures now and is going to cost you 7 or 8 figures over the course of your lifetime. A huge problem I see is that tax guys don't do investments and investment guys don't do tax. And I'm going to show you why your CPA might be doing a huge disservice to you. First, I want to make it very clear to you guys what a CPA is made to do and what type of person becomes a CPA. See, a CPA is a certified public accountant. These are people that have a deep understanding of public accountancy. And these are people that I work as I build out my business. I am actively hiring CPAs to be on my team. However, they do not head my strategy. The problem is CPAs know so much about math and numbers and finance and things like that, that's really what they want to do all day. They want to make sure the numbers are clean and accurate and tight. However, these are not people that are typically serial entrepreneurs, investors, and really aggressive types of people who want to win. And for me, being a former Division I linebacker and an entrepreneur who started multiple businesses now, I see everything as an opportunity. This is why for me, when I first started with dealing with CPAs, I was very confused because I would reach out to my CPA and I would say, hey, like, can we take this, home office deduction? And they would be like, no, you can't take it. Because I took like the standard deduction, or because maybe I had multiple business partners, so we couldn't take my home office deduction because it would go on their tax return, like whatever. Instead of sitting down with me and saying, well, maybe in your situation you can't take it this way, but if we take the right precautions, we can frame it as such and then get access to that deduction. Not no, but how can we? And tax strategy is very complicated, but the solution to it is to dive deep. And a lot of CPAs just don't want to do the work. They have so many clients that they work with that they just have to file taxes for that they don't want to sit down with every single one and discuss every little thing that they can do to lower their tax bill. It blows my mind that most people have not heard about the enrolled agent's license, okay? And this is like the CPA's older brother kind of counterpart that is the more dominant figure. See, EAs, enrolled agents, are officially licensed by the IRS themselves and are licensed in all 50 states to defend people in front of the IRS for their audits. They can file tax returns and they have a deep understanding of taxation. Key point, taxation. They understand the tax law. They don't just understand accounting. See, public accounting could be running a business's financials or understanding profit and loss statements, which EAs usually know how to do as well, but there's a different focus going on. One is focused on numbers and accountancy, and the other one is focused on tax. Very different things. CPAs are extremely smart people, but it doesn't mean that they're the best people for lowering your tax bill. And by definition, accounting is accounting for what happened in the past. It's backwards looking and not forwards looking. And this is something huge that you need to be looking out for with your CPA. See, if your CPA, your accountant or whatever, is working with you in November, December, maybe January, February of the following year, right, and talking to you about what happened last year, this is a huge problem. And you might meet with them once to like set up with them or maybe talk about some things throughout the year with how things are going. But if you're not actively strategizing, usually you're gonna just get smacked with a bill and they're gonna be like, well, that's the cost of making more money. And so what I'm going to do is go into 3 different points about the tax strategist versus the tax preparer side of things and help you understand if having a CPA in your team as the head of your tax planning is really a good idea or not. And more importantly, why CPAs more often than not are lazy and not actually doing everything that they can to lower your tax bill. So one, I want to talk about this idea between a historian and a strategist. And see, for me, as I build out my tax firm over these next few months, my whole goal with people, my clients, is to be preparing for the future and planning ahead. We run projections. We look at what income is going to look like. We explore real estate deals, oil and gas investments, and entity structures early on in the year as we start to understand our income, so that way we have time at the end of the year to already have those decisions being made and finalized. See, if you start talking to your CPA in November, well, you might have thought, wow, I made a lot of money this year, I need to invest in a real estate property. Guess what? You don't have time to do that. You have to do that early in the year. And this is a huge problem that many people face. If you are talking to your accountant in first off, after the year ended or in December, it's like, dude, there's nothing we can do. And I see people online that will they'll buy a car in the end of December because they need to get a tax write-off. And it's like, okay, that's great. I'm glad that you got the tax write-off, but don't you think there was maybe a better place that we could have parked your money if we had just thought about this 6 months earlier? No pun intended with parking your money, by the way. But even then, if we're not able to prepare, then we're not able to do that. And then also, CPAs are usually limited in their creativity around the tax law. So when we do get to December, a lot of times the things that they'll do to try to lower the tax bill are not really going to be helping you long term. See, instead of making a big business investment or making some sort of other, purchase, right, they'll do things like charitable contributions or buying a car or things like that aren't really investments. And I think giving to charity and buying cars are great, but that doesn't mean that they're the best thing for your tax bill and your investing future. See, in nature, when you have an accountant that is backwards looking, they are not forwards looking. And that's why you need somebody that is really investment driven. So for me, I already have it built out into the business plan in my firm that a year after we launch our tax unit, we are launching an investment and wealth management unit. And the reason why is we want to be looking at the investments and the tax through the same lens and say, what are we actually going to do? Because so many investment managers, they love throwing the money into the 401k and they love being able to manage it. And let me teach you a little bit of finance here so you understand how people get paid and why it matters so much. Always follow the money when you're working with people. The reason why is this: when your CPA has you throw all this money into a 401k, right, at the end of the year because they didn't do any planning beforehand, okay, they make money because you think that your tax bill got lowered, when in reality, it just got pushed off to a later year. And financial advisors love this because they usually get paid off of a percentage of the assets under management. So if you go put in 70 grand into a 401k, solo 401k, by the way, okay, they get to manage that money, they get their 1%, so they're making money, and your CPA is making money, and you think that you're getting ahead when you're probably not. And so for me, when I start my tax firm, it is going to be a flat fee firm. We get paid because we give advice and strategy to you, and then we charge an investment management fee for the strategies that we use there because we have to use a lot of complex software because it's a lot of complex asset management. It's not just like ETFs and stuff like that. But we do this, so it's like, hey man, no matter what you do, we're gonna get paid. And your CPA is not structuring their business that way. Being a historian only allows you to make decisions that are very limited. There's a whole world of entity structures, planning and keeping track of things, bookkeeping and investment management and planning for all this stuff that your CPA just isn't wise in. CPAs are not made to be investing type people, okay? Think about the type of person that becomes a CPA, by the way. They're usually not the Division I linebacker, aggressive, let's go take over the world, like let's build an 8-9 figure estate type of person. They're typically the very safe and calm person, the kid in your class that was really good at math, not the person that really wanted to go out there and win. Once again, no hate to CPAs. I work with them all the time. It's just a difference in mindset. Two is that CPAs are very fearful. They are afraid of what is the word called the audit. And not to say all CPAs, obviously it's very generalized, but most of the people that I talk to, they're very scared of audits and they don't want to implement strategies because they have audit risk. And there's a reason why, is because there's a lot of tax law and then a lot of court cases that point to the IRS saying substance over form. And what that phrase means is that it's the substance of the transaction that exists that determines whether or not something is actually a tax deduction or not. And this is very different, right, than maybe the just form of something, right? So a great example is clothes, right? So a lot of times you're not able to write off clothes, okay? And there's a tax section that says code section 162A, which says in the pursuit of business, you can basically spend money on anything that you think is in the pursuit of income. So people will be like, oh, I'm buying clothes. I wear clothes to work. This is my, outfit or whatever. It's in the pursuit of income. But the IRS says in court cases multiple times, no, it has to be outside of the nature of just normal clothes. So the form there matters less than the actual substance of the transaction, which is that it's a personal transaction. CPAs look at this and say, nope, the IRS isn't going to allow this. What I look at this and I say, as somebody building a tax strategy firm, is say, instead of looking at that and saying, oh, well, we can't do it, let's make it substantial. Let's provide the substance then, okay? Instead of looking at it and saying, oh no, the form isn't there, this isn't actually meant to be a business expense, so we can't write it off. Okay, well, no, let's make it about business. A great example is traveling, right? You should never take a vacation. It should always be a travel expense. But if you just go on a vacation, you can't write that off. But instead, there are certain tactics that we can use, right? Why don't we travel from Thursday until Tuesday, right? Instead of doing Thursday until Sunday. So that way we get the weekend as just a part of the normal business activity. And there's a big audit risk that is involved in some of these higher risk strategies. So for example, you might have heard about the Augusta rule, which is section 280A. And what that is saying is that you are able to legally rent out your personal residence to your business for 14 days and take that income completely tax-free. Most CPAs look at that strategy and they're like, I don't want to touch it because your business isn't actually like renting out your home, so we're not going to do it. But instead, what you need is somebody on your team that's going to go in and say, okay, we can do this strategy. However, there's a lot of animosity around it. So we need to take every legal measure possible to do this and to make it work. And that's what I do. So for me, what I would do in that situation is say, okay, the Augusta rule is legitimate. We can make that tax deduction exist. What we need to do is make this super legitimate. So what we do is we screen the area on, say, like Airbnb. We look for a very similar property in a similar area at a similar time of year. Time of year is very important, by the way. Obviously, more people travel during Thanksgiving, which makes those rates go up, allows us for more tax-free income. But what we can do is like we find 3 different properties that are all similar to ours, that are all listing for a certain price, and we're going to charge that rate, and we're going to draw up a contract between ourselves and our business, and we are going to actually hold a business event at our house, and then we are going to document and take pictures and take logs of what happened at that business event, and we're going to store it on a secure file storage. Okay, and then that way, if the IRS ever comes to us, we say, hey, we got all this stuff right here for you. We're gonna pay by check to our personal bank account from our business bank account and actually write what that check was for. So that way we have clean, tight, foolproof logs of everything. But your CPA doesn't want to do that kind of work for you. And that's why they are lazy. Tax planning isn't something we should fear. It's very complex, but it is all built in the world of crossing your T's and dotting your I's. And if you don't take that extra step, okay, then you're implementing stuff that is just going to get you in a lot of trouble with the audits and a lot of trouble with the IRS, because CPAs understand that and they don't want to have trouble with the IRS. But then there's also the TikTok guru on the other side that just throws out any strategy and starts doing it when they absolutely should not. They need to take the legal measures, and someone like an enrolled agent or a tax strategy firm is what's going to meet in the middle of those two and provide the best of both worlds. 3 is the standard advice trap. And this is what I see going on. See, most CPAs that run these accounting firms are very lifestyle driven, meaning that their businesses are usually compromised of working really hard for like 3-4 months a year and then being on minimum maintenance for the rest of the year. They're very much so what I would consider a lifestyle entrepreneur. They're not trying to become multi-millionaires. They're just trying to live a normal life. And there's nothing wrong with that. But the problem is that you might want to build an 8-figure estate, you know, a 9-figure portfolio of real estate and businesses and investments, right? But your CPA lives in the world of just, you know, owning a little, 3-bedroom suburban home and having money in their 401k and retiring and being chill. But you want to drive a Lambo. And so there's a huge discrepancy between these two types of people. And so your CPA is likely giving you very standard advice that is good, but it doesn't align with your goal. See, your CPA is usually not the type of person that's like, I'm gonna go drop 200K on an Airbnb on a state that I don't live in, and I'm gonna set up a management company and set up an LLC for that rental property and make sure everything is done tightly, and I'm gonna get it clean and professional photos and actually make an Airbnb. Now, if you don't know, Airbnbs create some of the best tax deductions ever. Usually you can put, say, $200,000 down on a $1 million property, and you could get between a $200,000 and $400,000 year one write-off. It's insane. And if you get a great property, they can cash flow a ton. But it's way higher risk, both from an audit standpoint and from an investment standpoint. And if your CPA is not the type of person to want to get involved with any of that, then you're not actually going to have the ability to get access to those investments. When you want to play in that world, you actually want to grow real wealth, so you have to make decisions for that. A very similar thing is oil and gas, right? There is a real possibility that you put $100,000 in an oil and gas well and make not much money off of it. However, you could also end up putting 100 grand into an oil and gas well and get a 90K year one deduction, and then that thing could cash flow you 12, 25% a year for the next 20 years. It's risk for sure, but it's one, avoiding taxes, and two, getting you into investments that will actually grow your net worth. See, most of these CPAs, they just want to say, put some money into a 401k, maybe take payroll, buy your own home and write off the mortgage interest, like whatever. But that standard advice doesn't fit your model. I talk to so many guys, and one of the first things that I ask people when I see if they're even a good fit to want to involve themselves in something that my business is going to be doing is like, what's your goal, man? Do you want to retire at 65 and have a couple bucks in the bank account and just live in a little home, or do you want to drive Lambos and have mansions? And they say, I want to drive Lambos and have mansions and I want to retire when I'm 35. Okay, so you want to retire when you're 35, but you put 80 grand into a 401k every year, you don't buy real estate, and you pay 50 grand in taxes, and you're only going to get access to your money when you're 59 and a half or 65. So where is there any alignment going on? There's not. And so if there's no alignment between your personal goals, your tax strategy, and your investment strategy, then what even is the purpose of all of it? You're not actually getting to where you want to go. And people don't want to think out of the box. See, for me, I'm the type of guy that will say, hey, let's not throw all the money into the 401k. We might need to pay more taxes up front and just keep the money into a brokerage account, but that'll allow us to buy a real estate property a year or two from now. But then what I do is I say, hey, I have a problem here, which is that we have a ton of liquid cash that we're going to get taxed on. We need to start direct indexing in your investment account so we can get some of that tax alpha back. And if you don't know what direct indexing, it's fine. It's really simple. It's basically you just buy the individual stocks instead of buying like an ETF with 500 stocks in it, and you can go sell all the ones that do bad throughout the year, and it gets you a little bit of a tax advantage. But the point is that you have to think outside of the box in terms of growing your wealth, and you need to have a team working with you to do it. This is why I have a team. I have a CPA team that I work with. I have an investment firm that I work with, and they go in and do a lot of the stuff for me because I have goals. I have a business, I have a plan, but I know I need to have the people who have the right skill sets working with me and the different roles that I need them. Look guys, in total, if you enjoyed this at all, you got to understand that there just might be more that you need from a tax and investment side of things. And I'd be happy to help you out. My business is not fully launched yet as we are in the building mode for sure. However, when we do launch, we are going to be taking on strictly sales reps that make over $100,000 a year. And I would be very happy to help you now set up the game plan so that way when we are launched, you are able to be ready to take off. Set up things like your books and what your general strategy should be for the year. I don't charge for any of this stuff yet, but it is a great way to get you off onto the right foot so we're ready to work together once the time comes. You can click the link in my bio, check my Instagram out at @ashablosky on all platforms. You can reach out to me and let's get on the phone and talk about it. As always, see you in the next video. Thank you.